Interest-only lifetime mortgage schemes are currently offered by two leaders, Stonehaven and More to Life. They work by having the options of paying the interest on a monthly basis. By paying off the interest means the balance will remain level for the rest of their life. This market is set to increase as more retirees require finance in retirement. Reserve mortgages. For older borrowers, typically in retirement, it may be possible to arrange a mortgage where neither the principal nor interest is repaid. The interest is rolled up like the principal increase the debt each year. These arrangements are variously called reverse mortgages, lifetime mortgages, or equity release mortgages, referring to home equity. Depending on the country, the loans are typically not repaid until the borrowers are deceased, hence the age restriction. Through the Federal Housing Administration, the US government insures reverse mortgages via a program called the HECM, Home Equity Conversion Mortgage. Unlike standard mortgages, where the entire loan amount is typically disbursed at the time of loan closing, the HECM program allows the homeowner to receive funds in a variety of ways as one-time lump sum payment, as a monthly tenure payment which continues until the borrower dies or moves out of the house permanently, as monthly payment over a defined period of time, or as credit line. Interest and partial principal. In the US, as partial amortization or balloon loan is one where the amount of monthly payments due are calculated, amortized over a certain term, but the outstanding balance of the principal is due at some point short of that term. In the UK, a partial repayment mortgage is quite common, especially where the original mortgage was invested backed. Variations. Graduated payment mortgage loans have increasing cost over time and are geared to young borrowers who expect wage increase over time. Balloon payment mortgages have only partial amortization, meaning that amount of monthly payment due are called amortized over a certain term, but the outstanding principal balance is due at some point short of that term, and at that end of the term, a balloon payment is due. When interest rates are high relative to the rate of an existing seller loan, the buyer can consider assuming the seller's mortgage. A wraparound mortgage is a form of seller financing that can make it easier for a seller to sell a property. A bi-weekly mortgage has payments made every 2 weeks instead of monthly. Budget loans include taxes and insurance in the mortgage payment package. Loans at the cost of furnishing and other personal property to the mortgage. Buy down mortgages allow the seller or lender to pay something similar to points to reduce interest rate and encourage buyers. Homeowners can also take out equity loans in which they receive cash for a mortgage debt on their house. Shared appreciation mortgages are a form of equity release. In the US, foreign nationals used to their unique situation face foreign national mortgage conditions. Flexible mortgages allow for more freedom by the borrower to skip payments or prepay. Offset mortgages allow deposit to counted against the mortgage loan. In the UK, there is also the endowment mortgage, where the borrower pay interest while the principal is paid with a life insurance policy. Commercial mortgages typically have different interest rate, risk, and contracts than personal loans. Participation mortgages allow multiple investors to share in a loan. Builder may take out blanket loans which cover several properties at once. Bridge loans may be used as temporary financing pending a long-term loan. Hard money loans provide financing in exchange for mortgaging of real estate collateral. Foreclosure and non-recourse lending. In most jurisdictions, a lender may foreclose the mortgage property if certain occur principally. Non-payment of the mortgage loan, subject to legal requirement, then be sold. Any amount received from sale net of cost are applied to the debt. Some jurisdictions mortgage loans are non-recourse on if funds recouped from sale of the debt mortgage property are insufficient to cover the outstanding debt. The lender may have recourse to borrower after A mortgage loan